This series adapts a framework from Scott Galloway, professor of marketing at NYU Stern, from his 2024 book, The Algebra of Wealth. Galloway calls it FSTD: focus, stoicism, time, diversification. Today we are taking the time pillar, and we are stress testing it against 40 years of investor data, real cases the book does not cover, and the cost of living math most U.S. authors miss. $500 a month. Starting at age 22. Invested in a low-cost broad market index fund. Average historical return. By age 65, that account holds roughly $1.6 million. The amount you actually put in over 43 years. $258,000. The rest, $1.34 million, was made by time. Not you. Time. Now flip the equation. Same $500 a month. Same index. Same returns. But you start at age 35 instead of 22. Same retirement age. Final balance? Roughly $410,000. You skipped 13 years and lost about $1 million. Same effort. Same discipline. Time was just shorter. This is the cruelest and the kindest pillar in Galloway's framework. He calls it time. We call our version the compound engine. Because it runs on 3 inputs you can read like a dashboard. Rate. What your money earns. Years. How long you let it run. And the one almost nobody measures. Behavior tax. What you cost yourself by interrupting it. Today we measure all 3. And we end with the question every late starter needs to hear. What do you do if you did not start at 22? Let me put the 3 numbers side by side. We assumed the same $500 a month, every month, into a broad market index fund. We assumed an 8.5% average annual return. That is roughly the long-run nominal return of the U.S. stock market over the last 100 years. The number Vanguard's century-long study lands on. The number we used in the Buffett $1 million wager. 3 starters. Same monthly contribution. Same return. Same fund. Starter. Begins at age 22. 43 years of compounding. Final balance at 65. Roughly $1.6 million. Starter B begins at age 35. 30 years of compounding. Final balance. Roughly $410,000. Starter C begins at age 45. 20 years of compounding. Final balance. Roughly $148,000. $1.6 million. $410,000. $148,000. Same monthly check. Same market. Same discipline. The only variable on the page is the calendar. That is what Galloway means when he says time is the dominant input. Quick pause. If a friend just started a 401k, or a Roth IRA, or any retirement account at all this year, they should see this video. Not next year. Now. Subscribe so this channel lands in your feed too. And so the algorithm sends the next 4 entries in this series in order. Subscribing is the lightest possible move you can make for someone you care about, who just started compounding. Now, back to the engine. Here is the part most compound interest videos miss. Inside the engine, the 3 inputs do not pull equally. Years dominates. Run the math. Take starter A again. $500 a month at 22, 8.5% for 43 years, ends near $1.6 million. Now bump the return up to 10%. Same 43 years. Final balance climbs to about $2.3 million. A nice jump. Worth chasing. Now leave the rate at 8.5% and add 10 years to the calendar. Start at 12, retire at 65. Final balance? About 3.7 million. The extra 10 years almost matched the work of pushing the return to a near impossible rate. That is the asymmetry. Galloway flags it as time being the dominant variable. Vanguard quietly proved it from the other direction in their lump sum study, the Vanguard 67% finding. 2/3 of the time, investors who waited to time the market underperformed investors who just started. Years was the variable. You cannot chase rate to recover years. Now the third input. The one Galloway flags but does not measure in the book. The behavior tax. The gap between the return the fund posts and the return the actual investor takes home. We unpacked the math behind it in the 1% discipline. Here are the receipts. Algebra publishes an annual report called QAIB, the Quantitative Analysis of Investor Behavior. For the last 30 years, the average U.S. equity fund investor has earned roughly 6.7 percentage points less per year than the funds they were invested in. That is not a fee. That is the cost of buying high, selling low, and switching at the wrong moment. Vanguard ran the same study with cleaner methodology and called it Mind the Gap. Their number is gentler, about 1.5 to 2% per year, on average, even among Vanguard's own historically lower emotion investors. Take whichever number you trust. Even the Vanguard 1.5%, compounded over 40 years, eats roughly 1/3 of what your portfolio could have been. The Dalbar number, applied to starter A, would cut that 1.6 million almost in half. The math of compounding does not care that this leak is invisible. It compounds the leak. If this is the moment the math is landing, do one thing right now. Send this video to the 22-year-old you know. The friend, the cousin, the niece, the new colleague who just got their first paycheck. The first 13 years of compounding cannot be made up later. There is no rate of return high enough to recover lost years. They need to see this number now. Not in 2040 when they have already missed it. The share button is right there. 5 seconds. Now back to the math. There is one number that captures the behavior tax better than any other. J.P. Morgan publishes it every year in their Guide to the Markets. Take the S&P 500 over the last 20 years. If you stayed fully invested, your annualized return was roughly 9.8%. If you missed the 10 best market days during that window, just 10 days out of about 5,000 trading days, your return drops to about 5.6%. Roughly half. Miss the 20 best days, you drop below 3%. Miss the 30 best days, you go negative. And here is the cruel part. Most of the best days happen within 2 weeks of the worst days. The crashes you panic sold into are the same crashes the rebounds came out of. In 2020, the S&P fell 34% in 33 days. The investors who sold during that drop missed the 10 best days of the decade in the next 45. Buffett used the exact same arithmetic at scale. We walked through Buffett's $1 million wager in detail before, his 10-year wager against 5 hand-picked hedge funds. He won by 68 percentage points. Not by being smarter. By refusing to interrupt the engine. Now the kind part of the math. Because so far this has been brutal to anyone over 35. So let me say this clearly. If you started late, you are not cooked. The math is harder, but the engine still runs. It just needs more fuel. Here is the trade. To match what starter A built, that 1.6 million, starter B at 35 does not need a higher return. Trying to chase a higher return is exactly the move that triggers the behavior tax. What starter B needs is a higher contribution. Run the math. To land at the same 1.6 million by 65, The contribution rises from $500 a month to roughly $1,200 a month. About 2.4 times the original number. Same 8.5% return. Same disciplined index fund. Years went down, so dollars went up. By the way, this is the symmetry behind the Trinity study and the 4% rule, the withdrawal mirror we unpacked separately. The 4% rule is the withdrawal mirror of this engine. Once you have built the balance, you can safely take out about 4% of it per year, adjusted for inflation, with very high probability of the portfolio lasting 30 years. Compound at 8.5. Withdraw at 4. Same arithmetic, opposite direction. Now here is the part Galloway's book does not cover. His engine is dollar-anchored. The 8.5% assumption sits on a 100-year track record of S&P 500 returns paid in US dollars, which is itself one of the most stable currencies of the modern era. The US dollar, the euro, and the Japanese yen, 3 of the 4 most stable major reserve currencies, have all preserved enough purchasing power over multi-decade horizons that the long-run real return math holds reasonably well across them. A Frankfurt investor compounding in euros, or a Tokyo investor compounding in yen, can reasonably expect the same shape of curve, with different absolute numbers. Where the engine becomes genuinely fragile is in markets without a stable currency layer. A Sao Paulo investor in Brazilian real, or a Buenos Aires investor in Argentine peso, faces a problem the US textbook quietly skips. Local currency inflation can eat 10 or 20 years of compounding in a decade of policy mistakes. The fix emerging market wealth advisors have used for 30 years is currency layering. Hold a meaningful share of long-term assets in US dollar, euro, or yen-denominated instruments. Most developed market retail investors can recover from a late start with discipline and contribution. Emerging market investors carry an extra term, currency. The global lens makes that visible. So here is the compound engine in one frame. 3 inputs. Rate. What your money earns. Roughly 8 to 10% for a long horizon broad market index. Years. How long you let it run. The dominant variable. The one you cannot recover with a higher rate. And behavior tax. The gap between what the fund earns and what the investor takes home. Roughly 1.5 to 6.7% a year, depending on whose data you trust. 2 of those inputs the market sets for you. The third, behavior tax, you set yourself. Every panic, every flinch, every market timing experiment, every social feed-induced reallocation, they all show up as a line on this engine. That is Galloway's time pillar, translated into something you can audit on yourself this week. The psychology version of this idea is patience, the disposition that lets the engine actually run. Today is the math. Here is what to do this week. Audit one of the 3 inputs. Just one. Rate. Open your main retirement account. Find the expense ratio of every fund in it. Above 0.2% for a broad market index. You are paying more for rate than you need to. Years. Open a calculator. Plug your current monthly contribution in at 8.5%. Push the start age back 5 years and look at the new number. Then push it forward 5 and look again. The shape of that curve will change how you feel about deposits. Behavior tax. Pull up your trading history for the last 24 months. Count the buys and sells. Above 12? The engine is invoicing you. 1 input. 1 audit. 1 number. The compound engine does not work in theory. It works on the page. One quick thing before we close. If this was useful, hit like and subscribe so the rest of the Algebra series lands in your feed. Coming up next, the anti-concentration rule. Why your index fund is not as diversified as you think. See you there. The framework is Galloway's. The math, the cases, and the global perspective are ours. Build wealth with patience, not panic. Calm investors.